Well, welcome, David, and also welcome on in everyone who is watching. Sure appreciate you joining us today, and excited to go over the Bethania PEA for Kuya Silver. Kuya Silver run by David Stein, as you can see on your left, who's the CEO, and joined today also by Christian Aramayo, who is the COO. And we will be taking questions today. The main point of this is to just give people watching at home the information you need. I'm quite fortunate to have been following the project, what David and Christian are doing for a while. And with that said, welcome, David. Welcome, Christian. Thanks for being here, and excited to go through this with you.
Thank you. Thanks, Chris. I'll get started right away. I'm very pleased to have with me Christian, as Chris mentioned. For those of you who are dedicated Arcadia followers, Christian did do a panel at the last Silverfest with us. He's not always in the public domain, but we're very happy to have him today for any of those really detailed technical questions that I'm not able to answer. So anyway, with that said, let's go through the presentation. It's kind of a modified version of our corporate presentation, and I'm going to try to go through the corporate slides very quickly, just the background for those of you who are not familiar with Kuya or you need an update, and then we'll spend more of the time on the PEA results themselves. So here we go. We've got our important disclosures. Please read these in your own time, and there is a copy of this disclosure on our website. With the company presentation. Okay, so the background, very quickly, very briefly, is our flagship asset is the Bethania Silver Mine in Peru, to which the PEA has been almost done. We'll have the full report out soon, but we reported the summary yesterday, and it's a mine that was in production up until 2016 as a toll milling operation. So where they were taking this very high grade silver polymetallic ore, trucking it somewhere else, having it processed. And, we got involved in about four and a half years ago now, and saw the opportunity to basically make this mine bigger and better through exploration and also developing our own plant at site, to become a big silver producer. In sort of by taking, kind of baby steps towards that, keeping the Capex low, keeping the project, sort of achievable and on a fast track. And really that's been our strategy from day one. So we're very excited. We've made a number of really important, operational announcements in the last year, including most recently our construction authorization. And then the PEA yesterday, as well as we've been also reporting exploration results at the same time, including the mineral resource a few months ago, and then we've made new discoveries on surface, new veins we've discovered since then as well. So the project's already getting bigger, which is really exciting. Our strategy is really following in the footsteps of other really successful silver mining companies out there, start with an undercapitalized high grade silver mine. What I really like about these underground mines is that they're much lower risk than the vast majority of mining projects out there. They're less controversial, smaller environmental footprint, lower Capex, and let's face it, Capex is probably the biggest risk to the industry right now. So we can manage that very, very well with our project that, will start small and then grow incrementally through cash flow, i.e. profit. So that's been our strategy from day one, and we're still executing on that. Here's where the project is located.
David?
Yes?
We actually have a couple questions coming in already. One was about the background of the previous owners of Bethania. How much was mined? Where was it processed? And then along those lines, Tobias asked, when do you think the processing of material by a third party could start?
Okay, so the previous owners are, a a mining family from Peru who they're not like a famous like Arias or Benavides, but they're a great family that Christian and I have been working with now for 4 or 5 years, and still shareholders in the company. So that's who owned it. They ran it up until 2016, put it on care and maintenance, and when they originally started mining in sort of the mid to late 2000s. In sort of the modern version of the Bethania mine, the most recent version of the Bethania mine, they started actually just selling the raw ore, and then they moved up to actually toll milling, where they were processing it themselves and then selling the concentrate instead of the ore. So getting more and more of the value chain, and then we're going to take it one step further and actually have our own mill. They toll milled at 3 different mills over the course of the 6 or 7 years that it was in operation. The various mills in the area, they were all privately owned, mills, very conventional lead zinc flotation mills, similar to what we were planning to build. And they were between 50 and 200 kilometers away was the furthest one. In terms of what we would plan to do in the PEA, as the listener correctly identified, there's a toll milling option that we've been scoping, and that would be planned to be basically 6 months before the startup of our mill, or we could start toll milling somewhere else, and what we do that as we're ramping up production to the full 350 tons per day. So in the PEA model, I think the average production is about 220 tons per day over that first 6 months, because it starts at 0 and it ramps up to 350. Okay, but good questions. So here's where we're located. As the crow flies, very, very close to Lima. It's about 170 kilometers. Unfortunately, there's a huge mountain range here, which makes it a little bit more difficult to get there, but we can get there. There are roads, and Peruvians have been living in the mountains for thousands of years, so we can get there very easily. There is a big city here called Huancayo that's nearby, and there's roads right from Huancayo to site. So certainly for our visitors, and when I go, I fly to Huancayo and then drive from there. That's the easiest way to get there. But you can also drive all the way from Lima. All right, let's take a look at our dual track value creation, because we put another check mark on here with the PEA. This is our step-by-step process of moving our projects along. And obviously, as you know, we've been focused almost exclusively on Bethania for most of this year, which we feel is very, very important to getting an uplift in our value, essentially a re-rating from kind of an exploration junior to a producer, which we could be in less than a year now, or about a year, depending on how the timing of our financing and all that goes over the next few months. So we're very, very close now. We can feel it, which is very exciting. Here is all the the various steps that we're looking at doing, both in the exploration and development side, and we'll make announcements over the coming months and years on that.
All right. And David, we have a couple questions coming in again. What are your expectations as far as production?
From Bethania? So look, the PEA kind of starts off at about 1.3, 1.4 million ounces equivalent per year of silver, which is a little less than we had been thinking when we were kind of scoping the project ourselves. However, there's a good reason for that, and that's basically because when our consultants were doing the economic analysis of the mine, by taking additional dilution as we mine, which is in the current in the PEA model, it significantly lowers the mining costs, and so we actually make almost as much money by mining lower grade ore as we would have mining 15 or 16 ounces per ton. That being said, we do think we can push it up higher between now and startup, and that's something that we'll do internally to optimize the project even further. And that's one of the many ways that we can make this project even better going forward. But anyway, that's sort of where the numbers lie right now. Certainly we'd like to push it up towards 2 million ounces a year through our optimizations, but that's going to be probably the range that we look at for at least for the first phase, which is this 350 ton per day. And then keep in mind, as we've said before, our plan is to expand it again to something greater than 350, whether it's 500, 700, 1,000 tons per day. We don't know yet, but that is something that we will be looking at doing over the next few years as our exploration kind of catches up with our development, because we've got a much bigger project here to explore and more ounces to find. And as we find those, we can then modify the mill to produce more. And that's really the plan.
David, we do have a follow-up question, which you kind of just answered, but just in case there's anything you'd like to add on to that from the same person. Mark was asking about the time frame, the potential for increasing your resource. So again, you touched on that a little bit, but in case anything else you'd like to add there.
Well, I'll leave the resource till the next slides. We've got a few slides on that before we get into that. So just be patient on that. We're very excited about the resource potential here. And I mean, in terms of the timing, look, the kind of construction ramp up timing is about a year. So when we make the announcement that construction has started, then we should be in full production about a year or so after that.
Okay, and the other question we had, what are the immediate next steps at Bethania?
Immediate next steps? So let's just park the project financing phase, because that's something that we don't do at site. Christian and I are kind of doing that with our investors as we speak. But once the project's fully funded, then maybe Christian can jump in here, but there's certain jobs that will start up right away in basically the first month, and then there's others that will follow. Maybe Christian, do you want to just explain that?
We're going to structure this in order to optimize the resource usage and time. We're going to start by civil works, both at the same in the process plant and in the tailings dam at the same time. That is basically the critical path that we have through the schedule. And while doing that, we'll be working on the long lead items, mechanical equipment, and steel equipment, while rehabilitating the underground mine. So basically, we will have everything ready, the foundations and the civil works ready for assembly.
Yeah, and then and then once we start assembling the mine, then we can commission it. After how long will assembly take? How many months?
Yeah, I think that once our current plan says that we will be doing civil works for the next 45 to 60 days, then we're going to assemble the whole plan in about 8 months, and we will start cold commissioning, followed by hot commissioning. Then we start up the plan, and the startup of the ramp up period will take us 45 days to 6 days, depending on you're starting up a plan, so we need to fine tune a lot of things. But we have that under control, are fully built in the schedule.
Okay. Thank you. So that's good. Let's move on now to exploration, I think is next. Yes. Okay. So I know you guys we want to talk about the PEA in more detail, but I think this is really important because, the PEA, while we're very, very excited about the results, it's really just a starting point for us. And this project is going to get, a lot bigger in the coming years. But, here's the layout of all of our land package in the Bethania district now. So we've got the mining concession is the black rectangle. The star is roughly where the mine is located. And then we've got the mill in the blue rectangle there is the surface rights where we can build the mill. It's called a beneficiation concession in Peru. And then all the other lands around there are exploration claims. And we've got the Carmelita project over here we acquired last year. That looks like to us like it could be a Bethania 2 duplicate. And we are, very excited soon to be getting in there and doing some initial work there. And then, the Bethania itself, as you'll see in a couple of slides, there's a lot more to be discovered just in this area, in the immediate mine area as well. So those are probably our two priority areas: is the immediate mine area, and then Carmelita, and then, but as you can see, we've got lots more land for regional exploration as well. This is a very well mineralized hydrothermal district in Peru that's been relatively it's been extremely underexplored compared to other mining districts in Peru, but we know there's a lot of potential here.
Okay, and David, if you could go back there a second, we have a few more questions coming in, and thank you to everyone who is asking questions. We do see those, so keep sending them in, and we'll get to all of them. But next question for you, David. When you develop a resource at Carmelita, do you expect to upgrade the processing facility at Bethania, or would you look at building a second facility?
Great question. Most likely, we would process it at Bethania, so we would incorporate it into an expansion of Bethania. There is a valley in between the two mines, so in terms of developing road access, it should be relatively easy to get ore from here to here. It's only about 3 kilometers, and Carmelita is on another hill, as you can see in the picture there, the photo. Bethania is on the side of a hill, Carmelita is on a hill, and in between there's a valley. So it's relatively easy to truck between the two.
Okay.
Any other questions, Chris, on this?
We'll just put in 2 here that are similar. How do you view the company's position relative to others that are looking to explore, develop the area? And also, Michael asked, any neighbors with claims nearby as well?
Yeah, I mean, there are other companies kicking around here with properties. I mean, most notably, Peñoles, Fresnillo, and Tech have properties in the area. There were other majors who were bidding for properties here, mostly copper guys actually, who are bidding on properties in this area that didn't get any in the last auction, but may come back. So I think some of the major companies, major gold and major copper mining companies, recognize that this district has big porphyry potential, and of course, with porphyry, you could get copper or gold. We're mostly interested on those little super high grade silver veins that kind of come up from the top of the porphyry, and that's what we're focused on right now. But we do recognize that there's big potential here in the region at depth, and we'll see what happens over time. We have by far the best land package now. We've accumulated it over the past several years, including big acquisitions last year. 2021, that was our most important year in terms of compiling our district scale land package here. I think if you compare us to the other players in the region, we have by far the biggest and best land package. Okay, all right. This is a sort of a screenshot of our 3D model for our resource estimate. I'm going to draw on this for a second, I want to kind of emphasize that here, this is the upper part where the mined out areas are. That's about where half of our current mineral resource is, which is 14 million ounces equivalent. And the other half is below, about here. So about 50-50 of our resources above and below the sort of the main. I'm sorry, I can't draw a straight line with my mouse, but you get the idea. The main mining at level, which is the 670 level, and so there's more veins and branches and stuff that we've discovered up here, and then we've continued to basically successfully extend all the veins at depth, and that's where a lot of the early mining is going to take place is down here. So that's one thing to keep in mind with this. The other thing is that this strike length of what we've explored and modeled to date, it's only about a third to 40% of the property, the mining concession that we have. So there's a potential, if these veins continue over this way, to double or triple the size of the deposit. And then again, we could double or triple at depth as well, because these are all open. So just without even leaving the original Bethania concession here, we have much, much bigger potential. Right now, we've got 14 or 15 million ounces equivalent. If we wave our arms a little bit and see, because we know there's mineralization over here in this area, that's the hilltop zone, which we've talked about. We can see this project getting to 30, 40, 50 million ounces just on the Bethania project, not including Carmelita. So we're really just scratching the surface here. We've done to date only 5,000 meters of drilling. I mean, if you follow the mining or the mineral exploration business, precious metals exploration, other silver and gold guys, you see them drilling 100,000 meter drill programs. And, what was important for us is really to do enough to get into production, and we can start making money. And then we know we can make this project a lot bigger. So it's kind of a different business model. I think those guys out there who just drill and drill and drill and drill, they're either doing it because their project isn't economic enough, and so they keep drilling until it is, or they just actually are not serious about putting something into production. So that's why, so it's a very different business model. We like our business model. It's much less capital intensive, and I think we'll generate better per share returns over time, because we won't have to dilute our shareholders as much if we're doing these $20-30 million drill programs all the time.
All right. And David, we have a couple questions on that slide. Is it common to develop a PEA with such a small amount of data? And how deep do you expect mineralization to continue?
So, I mean, small amount of data is relative, because the density of our data is very good. I mean, we have a lot of data in this small area, which has, the resource, the inferred and indicated resource of 14 million ounces combined. And keep in mind, we also have a significant mining history here as well, and recent mining history. It's not like it was like 20 or 50 years ago. This was like 5 years ago. This was in production. So we've got recent mining history that we can use as well. There's a lot of data underground. So actually, if you go through our mineral resource technical report, you'll see there's thousands of samples that have been taken underground that are part of our mineral resource database. So I would say, actually, for this relatively small area, we actually have a lot of data, and therefore we're very confident about what we're putting out here with the PEA. What was the second part of that question?
How deep do you expect mineralization to continue?
Okay, that's that. Yeah, so that's a more of an arm waving exploration question. But to answer that, I would say, look. So right now we've got. I mean, roughly speaking, it's different between the three different vein systems that we have here, but we're roughly down about 200 meters here from the surface. Okay, that's roughly 200 meters, and these hydrothermal vein systems, these silver-rich vein systems, they can go hundreds of meters. Even there's even some mines that are still mining at a kilometer below surface, or 1,000 meters. So I think for us to go to 400 or 500 meters or double this thing at depth, I think is quite reasonable. I mean, there's certainly no structural things like faults or anything that we've seen to date that would prevent us from going deeper here. And in fact, you never know. You could actually get the deposit could actually even get bigger at depth, or higher grade, because you're going to have fewer veins coalescing into bigger structures at depth. That's typically what happens. And so we're very, very excited about the depth potential. But just to answer the question, that's what we think internally.
All right, thank you. And just a quick note to everyone else who has asked a question: we have a lot coming in, but we will get to them. And David, I'll let you continue with the slides.
Okay, here's the resource. I've already talked about this, so I won't spend any more time on it unless there's any questions on it. No, let's move on. Okay, here is our Well, this is just one of the three vein systems. So we had 18 veins in our mineral resource that we put out in January. So what we did is we combined them into what we call vein systems: Espanola, 12 de Mayo, and Victoria. And because they're all basically, those three systems are controlled by the same basically mineralized structures. So this is one of those vein systems. This is actually 12 de Mayo, as it turns out. This is the one that's been mined the most historically, the most mined out. But you can see there's still quite a lot of mineralization here on the west that's not mined out and will be mined by us, hopefully. And then it's open along strike and at depth. And these pink areas here, which, by the way, if you go to our January press release, you'll see the other two drawings for the other two vein systems. They're almost exactly the same as this. They've got the pink high grade zones, which sort of plunge vertically at depth, and then the medium and lower grade is sort of around it. So that's very typical of of a high grade vein system like this, and that's what we have too. All right, so now let's talk about the PEA.
And David, I just have a request as you're going through that for the folks that are new to mining. Can you briefly run through NPV, IRR, what would be considered a standard IRR for a mining company for anyone who's new to those terms, please?
That is a great question, Chris. And I love to educate people as well as promoting Kuya Silver. So look, so a net NPV stands for net present value, and it's something you'll see a lot from economic studies of mining companies for a project. And basically what it is you take the cash flow, the free cash flow of the whole project, and then you discount it in time. So the further the cash flow is away, the less it's worth. For example, if I were to give you, $10 million this year or $10 million in 5 years, what would you rather have? You'd rather have the money now, of course, because you can do something with it. So money is worth more now than it is in the future. And that's basically the principle behind net present value. So, and then the other thing is, obviously after tax is important to look at. That's more of a situation where, let's say you were just going to run the mine just like it is in the model from start to finish, mine it for the 7 years in our case, close the mine, and you never reinvest in it again. And then what happens is, as soon as you have used up all your tax credits, you got to pay tax. You pay full tax. Of course, what really happens in mines is you keep reinvesting in the mine. You keep doing exploration, which is tax deductible. You maybe do an expansion in our case, which is going to be tax deductible. And then you actually defer paying taxes even further, or you reduce your taxes in further. So this is almost sort of like a worst case or a replacement value type calculation. But anyway, worth keeping in mind what these numbers really mean. The IRRs, the internal rate of return. This is basically a calculation of your annualized return after you've paid back your capital. So you obviously start negative when because you're putting capital in first, and then you start getting paid once the mine's in production, however many months or years later that is. In our case, because our mining schedule is short, our development schedule, I should say, is short. And our mine is so profitable, our Capex is also very low. So those factors combined make for a very high rate of return. In the industry, what you would typically see is usually something in the 20 or 30% would be considered pretty good. Some of the big $1 billion projects, $1 billion copper porphyry projects might even have IRRs in the teens and still get built. So having basically triple digit IRR is, it's extraordinary, but it's very, you can only see that really if you've got a low Capex project, because it's all about, we don't have that many negative cash flows. Our cash flows aren't very negative in the beginning because the Capex is so low. compared to most other projects. So, okay, so I think that's the lesson, the TED Talk on NPV and IRR for now. People can ask me any questions either now or offline if they want to talk about more about that.
David, we have one other follow along there. Could you talk a little bit more about the payback period? And is it fair to have mine payback so quickly?
Yeah, I mean, payback period is a similar to IRR. So a high IRR, you're going to have a lower payback period, generally speaking. So they're related numbers. Payback period is a better way for the average person to understand what an IRR is really. So you can say, well, we're going to spend X millions of dollars, in our case, $15 million, or 17 or 18 with the contingency, I should say. And then we're going to get paid back in 6 months, 0.5 years. So that's really the payback. That is very, very low. Again, a typical mining project, let's say a gold open pit that's going to be several thousand tons per day. You might be in the $200 or $300 million Capex range. It might take several years, or it might take at least a year, if not 2 or 3 years, to pay that back. Some of those big giant, copper projects have 4 or 5 year payback periods. I don't think you want it any more than that, though, because then it becomes really risky. Of course, the longer your payback period is, the more risk there is that something's going to go wrong in those years before you've paid back your capital. So obviously, it's better to have as short a payback period as possible. All right. So with that being said, maybe what we can do here is just move ahead to talk about the different components of the PEA, and I can answer questions along the way there as well. But you can see we've divided it into value, which is basically the NPV and the return. Cash flow, after-tax cash flow of 18 million we're forecasting in the first year. I think the pre-tax is 20 million, something like that. So it's close to the same. And obviously, just keep in mind our market cap is only about 30 million US right now. So it's only about, we're only trading at about 1.5 times our first year of cash flow here from the mine based on the PEA. Okay. And then we've got the costs, which are very low, obviously, and we can talk more about that. And then our production metrics, our metal produced and our grades, we'll talk about that as well. Okay, so let's start off with the Capex. You can see the various components of that we put. This is right out of our press release. And the initial Capex 14.2 plus the contingency, 25% contingency is what we're reporting. You can see that the plant and the tailings and the mine, those are the sort of the three big jobs, and then there's some Capex for surface infrastructure, buildings, roads, etc. as well. And that's our project is very simple actually when it comes down to it.
David, one question about the slide you just had up there. How does that compare with what you were looking at going in? Has that changed much?
I mean, we've been giving. I feel like we've been modifying our expectations as we've been developing this project over time. But it's sort of stayed in that lately, the last 6 months or longer. It's sort of been in that 15 million USD range. Certainly, if you go back 2 or 3 years, we were thinking this was going to be more 10 to 12 million. But of course, there has been some cost inflation, and that is reflected in this. And we all in the financial world, we all talk about inflation all the time. You guys know that it exists, and it exists with our project as well. And fortunately, when you're small to begin, when you've got a low Capex to begin with, a 10% move in your costs for us is $1.5 million. If you're at 100 million, that's 15 million. And then you got to go and raise that, right? Raise another 15 million. That's not easy to do. So Anyway, it's essentially a hedge in a way for inflation, the fact that we've got a smaller Capex project. Okay, Bethania production schedule. So one thing I didn't mention before, but in the PEA, we have modeled a pre-production scenario where we toll mill for the first 6 months. I did mention this earlier, the beginning, and you can see that that we produce about 40,000 tons that way. We also, by the way, it's not in the stockpile's not in the PEA, the current low grade stockpile that we have, right, Christian? No. So we also have another 25,000 tons of low-grade stockpile at site. We haven't factored that in, so that's sort of a little bonus that we can figure out what to do with later. Year one, that's basically ramping up to full, or that's basically a full year of production here at 350 tons per day, and then the life of mine, including the pre-production 6 months, it's about 7 years of mine life exactly, almost exactly. You can see the other thing I'll mention is that the 3 vein systems that we have, Espanola has the biggest resource and it's going to have the most production in terms of tons per day. But we are going to produce from all 3 at the same time. The schedule will vary month to month, year to year, but over the life of the mine, this is how it breaks out. All right, this is now looking at sort of per ton costs and then our all-in sustaining costs, which is that's kind of the standard metric now for precious metals. You'll see gold and silver companies using this. We do not credit our byproducts against this. So what we do is we take all the costs, we divide it by the silver equivalent ounces. This project is 70+% silver. At basically, current metal prices. It is a true silver project. It's not a zinc project masquerading as a silver project. This is a real silver project. But we do have the byproducts as well. So we factor all that into the all-in cost, and you get a lower cost in the first year because the grade's higher in the pre-production. Then you got about $10 in the first year, $10.50, and then 12 life of mine. So the costs are lower than we expected. Again, that's because we're mining in a cheaper way and taking on some dilution as a result of that. All right, and then I think lastly, but importantly, this is the summary of the economic numbers. Our base case was done at $25.4, which was the silver price up until a few weeks ago. Was very close to that. I mean, the silver price has really been in that $24 to $26 range for most of the past 2 years, with a couple of blips up and above and below that. And of course, we have seen a weaker silver price. So if you want to look at the 90% case, which is this is about where spot is today, very close to spot. You can see that our project is still very, very robust in terms of the NPV and the IRR and the payback. Those are all fabulous numbers. Even if you go to $20, it's still fabulous. So we've got a really, really strong project, obviously, but we don't think we'll be building it with $20 silver, but we could if we had to. Here is a layout of the slide. So I kind of just put this in the deck in case we get any questions about some of the details of what the site looks like. But if you think about that exploration, the district scale exploration slide that I put up earlier on, the area 1 is the mining concession. Area 2 is the surface concession for the plant. And you can see where our plant is located. Our tailings is, here, I'm going to draw on this. This is the tailings storage, this kind of square polygon thing here. This is the plant here. And this is the mine is all in this area here. So that's where everything's located, but it's very well designed, planned out, and we're very close to being ready to build here. Whiteboard off. Okay. Flow sheet, again, this is on its side, but again, we'll come back to this if there are any questions on the flow sheet. We don't need to talk about it right now. Exploration. These are some of our best results that we've had, both drilling and sampling, surface sampling and underground sampling. One thing I want to kind of just emphasize here, and I'll do it on the next slide, is the hilltop zone, which includes our best surface sample that we've ever had in the Santa Elena vein, which was 91.1 ounces per ton silver and 5 grams gold. And then there was some other high grade gold and silver in the same vein. That was the best one though. And we've made 5 or 6 new vein discoveries here in this hilltop area, including Santa Elena. We are very, there is an old working here as well, not part of our resource, called Española Dos. So we are very confident that there's going to be, a lot more to be found here. We will focus more on it in future exploration programs, but we think that we'll be able to connect all this under the hilltop here to the main mine area, and basically this will just be one big mining system. If we again look at, and I talked about this earlier, we look at depth, we can do ×2 here. We can do another ×2 here, because this also could go deep too, right? And then who knows what's in here in this connection zone? Who knows what's over here? There's actually a prospect over here just off of our property, but we do have the claim next to it now. So this is on our land, and it just demonstrates that this whole area, this 1.5 plus kilometer system, is mineralized. So there's lots more to be found here. And again, whether it ends up being 20, 30, 40, 50 million ounces, I think it'll be in the upper end of that range, but we'll see over the next few years. Carmelita, I talked about earlier. I won't mention again, just that we think it's very, very similar to Bethania, and it was in production up until 2020 by the previous owners. So it's also another more of a kind of artisanal, not as good records kept as Bethania, but it is a real, they were doing real mining this same type of high grade silver polymetallic ore, and then selling the raw ore to other mills. Our community is the Proche community, both on Carmelita and on Bethania, and we've got a great relationship with them. We just actually have signed our long-term agreements with them for the mine and the plant area. Looking forward to partnering with them over the many years going forward here. This is our current share count, not including the private placement that was announced that is not closed yet. That'll add another roughly 2 million shares out to this. But any way you slice it, we're our market cap is very small and very undervalued. And that is it. I won't go through the management, but this is the rest of our corporate presentation. And then maybe now, Chris, we can open it up for more questions. And I'll just go back if there's any slides we need to look at again.
All right. Well, thank you, David. We do have plenty of questions. The first, it's taken some time to get the PEA out. Will those things that delayed the PEA continue to impact the speed of the construction?
Okay, let me answer that. But look, the PEA was delayed more by us, I would say, in the sense that we just had more higher priority things that we wanted to deliver to the market over the last 6 months. So the PEA has been doing certainly our consultants have done a great job behind the scenes putting everything together. Our Kuya team has been working to put everything together as well, like all the detailed engineering work, etc. that's been going on behind the scenes. So really, we internally decided, to kind of fast track some of the other stuff, and that's really what's happened. Look, we've been in a really, really terrible silver market for the last, number of months, even going back to 2021. So I think regardless of whether or not the PEA was out now or whether it was out in March or whatever, we'd still be in the same spot today as the bottom line, in my opinion.
Okay. And you touched on this a little bit in your presentation, although a couple of questions related to the same thing. You mentioned in January the company might start production by the end of the year. Is that still doable? So any comments on production, and also a follow-up to that, what percentage of the 1.37 million AG equivalent is pure silver?
Okay, well, as I've said before, from the time we announced the startup, it's roughly 12 months until the mill's built and we're fully commissioned in full production. However, we could produce before that with the toll milling option. Christian, do you want to answer that?
Yes, of course. We keep our statement and word that we will be producing within this year, as the mine will be start up with this year. As David explained, we have this alternative of optionality to use toll milling alternative. However, we can also stockpile the material and the mineral for ourselves. Therefore, in a couple of months, we will start up the mine again, and we'll be producing within this year, as we have said. It's important to mention that for those of you who follow Kuya, we have always delivered to whatever we have said, and we are keeping that. So that's not, you shouldn't hesitate or have a doubt about that.
Yeah, thanks. What was the second part of the question, Chris?
The second part, let me pull that back up. Was the percentage of the 7 million AG equivalent, how much of that is pure silver?
Well, I could answer that, but I even have it on the slide. So let me go back to it. A couple more. I know there's a faster way to do this, but sorry. Here it is. So it's 73% in the first year and 70% life of mine. Now that does vary depending on the metal prices up and down. That's based on our metal price assumption. But if we're bullish on silver and we think silver is going to outperform the base metals, then it could be even higher than that.
Okay. Another question that comes in quite a bit in terms of nationalization, Peruvian government. Could you provide an update of where things are at? Any concerns or how you're looking at that right now?
Go for it, Christian.
Okay, first, just for everybody, it's let's say peace of mind. Peruvian legislation does not allow or has the provisions for any kind of nationalization. Okay, so nationalizations are completely off the table. Constitution needs to be changed. It has just been forbidden by the Congress, so there is no potential for that. Therefore, we don't foresee in the near future, mid-future, or basically in the long term, any kind of nationalization really here happening in Peru.
That being said, I guess the geopolitics of we still need to operate there, and so the geopolitics are important. Even besides the nationalization is sort of that worst case scenario, which, as Christian said, is very, very. I mean, it's basically impossible right now, and would be low probability over a long period of time. They'd have to change the constitution to do that. But look, I think the new government came in last year in a very tough time with COVID. They're kind of a protest party or a protest movement against the previous sort of the previous governments that have been very corrupt, etc. So Peru's going through a bit of a tough transition right now, but I think it's from the point of view of the mining industry, we've been able to operate really quite seamlessly. There are hundreds, if not thousands, of mines in Peru, and yes, there's the odd one where there's a protest or something like that. But I mean, again, in a country where so many mines, that's bound to happen. So we manage our project-specific risk with great community relations, first-class environmental performance, and good operations and engineering, and with that we feel like we're very low risk.
David, along those lines, can you talk about the relationship with the local community? We have someone asking.
Sure. Christian, do you want to talk about that?
Yes.
Maybe about the agreements we have?
Yeah, we have like the good thing about where Bethania project is located is that we're in a community that only have 30 communers basically, because you can have like a bigger population, but only certain people have voting rights in the community. Usually mines are located in 100, 300 like members. Our community is very small. On top of that, we have very good relationship that have been inherited from the previous owners. As David said at the beginning, this was run by a family who has very close ties with the community. We are keep developing that. That has been helpful for us, and that they have been helping us to get where we want to go. For instance, we have all the surface agreement in place for the process plan. We just renew and extend for 10 more years the surface right agreement for the mining concession area. We are working with them in green initiatives like to improve the breeding of their alpacas that they grow up there. We are working with them to improve also the grass that is basically the food of alpacas. We are bringing red clover that is more resilient to high altitude, cold weather. It's also have more nutrients, so the alpacas actually grow better. We are working with them, improving their quality and life standard as well. We are renting their houses, improving it, and working with them, and feeling them and making them feel that we actually make a difference on their life on the good side. They see that having us there is having a partner that is helping them develop and helping them to get where they want to go in the way they want to get, without imposing anything or trying to set previous standards or framework that had already either failed or worked somewhere else. We do understand that every community and every person who lives there is different. So that's why they value us a lot, and we believe that we have in them like the best of the partners that we could have.
All right. Thank you, Christian. Next question. You're presently involved in a finance. How is that going, to whatever degree you can comment on that, and any challenges that you foresee there?
Honestly, I'm been pleasantly surprised with, we announced a small financing about a week and a half ago, very, very pleasantly surprised with the reception from some of our big shareholders to participate and support us. I mean, the biggest problem that we've had is that the silver price has been down 9 out of 10 days since we announced it. So, what can you do? But anyway, no, it's going to be fine. We'll close it very soon in the next few days, and then we can move on to the bigger, more important financing, which is the project financing.
All right. Interesting question here from Ali. Mentions wanted to congratulate you on the initiative to diversify the investor base into the Middle East. He likes that strategy. Certainly interesting for those who have studied the history of some of the groups involved around the Hunt brothers' time. Is that something you plan to keep going and moving forward?
Christian, do you want to take that one?
Yes, of course. We have very good partners in the Middle East. They have been helping us a lot. On top of that, we have been invited to speak as main speaker in their investment forum that will be happening June 6 to 8 in Dubai. It's an investment forum, and the only ones who will be talking about mining in the GCCs, and also GCCs investing outside, like in Peru or other regions, is Kuya, because we have been working very closely with them. They value basically what I said before. We said what we are going to say, and we always deliver. So that's connecting very well with basically any kind of investors, and the vision 2030 of Saudi Arabia, for instance, is that mining should become even more important than oil and gas. Therefore, there are investors there that are eager to invest in mining companies where they can trust in the team. And I think we tick all those boxes.
Yeah, I mean, the mining sector, especially when you go into the junior, the market caps that we're in, sub $100 million market caps. There's just so many companies out there. As you guys, maybe the investors know that there's dozens and dozens of mining companies, all sorts of commodities, gold, silver, uranium, lithium, whatever. And, obviously there's great investors here in North America. And, that's how we kind of got the company started, mostly with North American investors participating, but we found it hugely beneficial to broaden our horizons. And Christian is going to be in Europe in the next few months. He's going to be in the Middle East the next few months. I'm going to keep talking to investors here in North America. I've got some conferences coming up in the US that I'm doing in the next month. So between Christian and I, we kind of divide and conquer the world, and we're always telling the Kuya story.
And I think people appreciate that, David. Although we have a couple more questions rolling in. What is the assumed recovery rate, and has there been any testing done on that yet?
Yeah, there's a chart, or there's a table or a bullet in the PEA on that. So we did report what the average is over the life of the mine, and we have a sort of a combination of testing, historical tests, also the actual results of the mine from the last few years, where we have the metallurgical data from the toll milling that they did, and then combined with some newer work that we've done since then. So when you put all that together, we model, I think, something that's actually really conservative. We're not being very crazy here with the assumptions, but from memory, 92% silver recovery. I think around 90% on the lead. I think low 80s on the zinc, and then the copper and the gold is much lower, just because the grades are so low. But it is worth recovering, and also the other benefit to producing the copper is we actually get more silver, payable silver as well. Because there's always a small bit of silver that doesn't report to the lead con. So we're going to get it in the copper con.
Okay. And we have a couple of questions from Brian here. The first was, what was the thought process behind choosing the discount rate on the NPV calculations? Was that risk adjusted, or was there a set of comps you used to derive an average rate?
Great question. That's a whole other TED talk we could do on discount rates. For what we did, though, is we mostly looked at comparables, and at least in the recent times, for precious metals companies, 5% is a pretty standard rate. You even get the odd analyst that'll go use a 0 or almost 0% discount rate. Basically using, saying, well, the risk-free rate, whether it's, U.S. Treasuries or whatever is, 0.25 or whatever percent. So they'll use an even lower rate. But the discount rate is really intended to factor in all the risk that you have as an investor into one number. And so you could also argue that it could be higher. So anyway, 5% is a nice middle ground. Base metal projects, you will often use a higher discount rate, maybe towards 10%, 10% sometimes. Precious metals, typically no more than 5. We do have a sensitivity table in the PEA, which will come out in the next few weeks. The full big document that will show sensitivities to different discount rates. But with our project, the discount rate doesn't make a huge difference. just because it's very profitable. The mine life isn't huge. That's the other thing. Discount rate penalizes cash flows in the distant future. So the higher the discount rate, the less your money's worth in the future. So in our case, that it makes a bit of a difference, but not a huge difference.
All right. Thank you, David. And the other question from Brian was if you could discuss Eric Sprott's involvement with the company and his background there.
Sure. So Eric actually invested in us privately first. And so, when Kuya was private in 2019, we got Eric in as one of our big investors, shareholders. And then he participated again when we went public, and so that's been his history with us. I've known Eric for more than 20 years. When I started in the business right out of university, I was working at Sprott Securities, and he was the chairman at the time. And so he met me when I was in my early 20s, and we've kept in touch off and on from there. So it was really somewhat of a personal connection there. I can't really say it any other way there. That if he didn't know me, if he doesn't know you, it's very, very difficult to get in front of him. But as you might imagine, so very, very fortunate to have him early on as an investor. Been great, and that's really the story there.
Okay, and certainly good to have him on board. Next question in here: in what year is construction expected? Could you describe the permission line before the operation?
Okay, well, let me just briefly say, and then I'll pass it to Christian. So right now we're looking at, somewhere around, excluding the toll milling. Let's forget about the toll milling for a second. Just for our own milling, our own mining and milling, we'd be looking at mid next year. Because it's about a 12-month project from start to finish. In terms of the permission, we're basically ready to build. There are some minor things that you need to get as you do your construction and operation and start the operation. But the real risky permits or the permits that take the most work we've already got them. But anyway, Christian, you want to elaborate on that?
I think you have covered that. We are ready we have all the authorization to start constructing. We will start constructing this year, and then we will start this ramp up, as David says, around mid next year with our own material. Because remember, we will start producing from the mine within this year. So, and we are ready with the required permits to do what we need to, the tasks that we need to do in the appropriate time, that we need to get the remaining very few authorizations.
Yeah, it's much like building a house. As you do the jobs, you have to get things inspected before you can go further. And just like before you put your drywall up, you have to get your plumbing and your electrical inspected. It's kind of the same thing with mining.
All right. Thank you. And again, thank you to everyone who's out there participating. A lot of great questions coming in here today. And we all appreciate you spending your time here. And hopefully you're getting some good information that you were looking for. A few last questions. Here's one from Greg. What mining method are you proposing that will increase dilution but decrease production costs?
Christian, do you want to talk about the mining, the stopes and stuff, the mining size?
Yeah, but what we are planning to do actually is we will follow the Peruvian traditional mining method. Let's say there is cut and fill with and slashing, and something that is called circar in Spanish. Sorry, I'm not exactly sure how to translate it to English, but basically you make a mine box, and then you make very, very small stopes in such a way that you control your dilution, getting as low waste as possible. So it's man hour intensive. So then when we start getting bigger, when we start getting past the 350, let's say at some point, we can start automating it and make bigger stopes where we are going to have more dilution. However, our mining cost that is already low should be lower. one of the important things how we are going to get our mining costs even lower, our production costs lower, will be with improvement of energy usage. That's something that we have already planned with David, and is part of our strategy in the very low period, in the very like short term. And also, what's something that we have realized that is important is to use the current traditional mining methods to decrease and faster the learning curve and put everything into production as fast as we can.
Yeah, I mean, in general, there's a trade-off between basically the size of your working areas and the cost. So the smaller your working areas, the higher the costs are going to be per ton, but you'll have less dilution. And so that's something that we're going to work to optimize between now and startup, is to see if we can do a little better than that in terms of the stope sizes. Because obviously, if you mine less, yeah, maybe your per ton costs go up, but if your grade goes up even more, then there's a benefit to that, right? So it's a trade-off study kind of thing that we can do as we go from today at the PEA level into production later this year.
Okay, and I did have a question coming in if this is going to be replayed, and this will be posted on the Kuya YouTube channel later today. So anything you'd like to review will be there. A few final questions coming in here. David, could you see the Bethania deposit topping 50 million ounces?
I think if you consider Carmelita and also the regional potential, then yes. I mean the land package that we have right now is it's very, very considerable, and this is an area that we know there's been a lot of historical artisanal mining in the area. There's nothing going on right now, nothing active, no illegal mining right now, but there's a lot of work that's been done in this area historically, and so between just the Bethania area where the black rectangle is, Carmelita, and then there's all this area in between here that could have more. We could make more discoveries as well. So honestly, I think this is the very beginning of a brand new district, silver district, that we control. If you go elsewhere in Peru, there are silver districts similar size to this, but that have produced maybe 100 million ounces over the last 100 years, or maybe they produce 50, but they've got another 50 in resources or whatever. This is, I think, a similar scope to that, but we're in the earlier days. Because there hasn't been as much historical mining for whatever reason. It's been smaller scale, but we think we're really onto something big here.
Okay. And David, how will you optimize grade? Will you expect to increase the head grade as you move into production?
Well, there's a couple of things there. There's the sort of the possibility that we mine more selectively underground than what's been envisaged in the PEA. So that's one option, and that's something we can do. We can see stope by stope. It may make sense in one part of the mine and may not make sense in another. That's something we can refine as we get closer to production here. Another thing we're looking at very seriously is something ore sorting, which is something that is it's been done in more of an informal way in Peru forever, but there's also more modern sort of engineering, high-tech ways to do it now, and I think there's somewhat of a spectrum between lower capex to do maybe a more primitive kind of ore sorting method to capex, higher capex, but more sophisticated. And I think we'll start with the primitive. We'll move to the sophisticated over the next few years. And but I think in a deposit like this, ore sorting is actually really important to optimize the grade as well. So that is something that we're looking very strongly at. It's not in the PEA whatsoever, though. So anything we can do there is going to be a bonus.
All right. Well, I appreciate that, David. And I think that's it for today. I appreciate everyone else who is out there asking the questions, taking time to learn more about the project. Should anyone have any follow-up questions for either of our speakers today, you can go to kuyasilver.com to the contact tab, and you can be sure those will get answered. And again, just thank you both for being here today and for what you're doing, Christian and David. Not the easiest economic environment, although I think your efforts are going to be well compensated in due time. And again, thank you to everyone else who is here listening today.
Yeah, thank you, Chris. You did a great job as our host today.
Okay, thank you. And everyone at home, we will see you again soon. Thanks for being here.
Bye.
Bye.